If you've inherited an IRA or a retirement account, you might be wondering what happens now. Do you have to pay taxes? If you're the spouse, can you move it in your own name? What if no beneficiary was ever named? I'm here with Mr. Pete LoSavio from LoSavio and Dejan to help walk us through all of that. How are you today?
I'm doing great today. This is an area where we get a lot of questions. It's a very complex area, a lot of misinformation, a lot of misunderstanding. If you have this issue, it's best to consult with somebody who's a specialist. There's a lot of people that should know the rules don't.
Let's talk about the common situation. What if you've inherited an IRA from a spouse?
The spouse is in the best situation of any person who can inherit an IRA. The surviving spouse has more benefits than any other person. They have a choice of either rolling it over into their IRA or just inheriting it as an inherited IRA. If you are trying to delay taking it, then it might be better to roll it over into your IRA because then you can delay it to whenever your withdrawal period is. But if you want the money immediately, then it might be better to just not roll it over.
What about non-spouse beneficiaries? Do they have to pay taxes on what they inherit?
Of course. Uncle Sam always wants his money. Now, with the Roth IRA, or the Roth, they don't pay taxes.
Seems like a Roth IRA is more beneficial than a traditional IRA for beneficiaries.
Yes. If you're going to inherit something, you want to inherit a Roth. On a traditional IRA, they have taxes to pay. That's why it's very important to do income tax planning if you have retirement accounts, because a lot of times your children are in higher tax brackets than you are. So this may be a situation where you paying some taxes by doing a Roth conversion could save your children a lot of money. It could also save you a lot of money too, but you have to look at the overall effect on the whole family.
Let's talk about RMDs, required minimum distributions. How do they work for someone who inherits an IRA?
Again, it's a complicated area that depends on the situation. If the person who passed away had already started to withdraw from the account, then the person who inherits it has to continue to withdraw from the account using the IRS schedules. If the person who passed away had not started to withdraw from the account, then the general rule is that they have up to 10 years to withdraw the money out of the account.
And what happens if you forget or don't take the RMD?
Very bad things. They charge you 25% penalty. So you don't want to make that mistake, which a lot of people do just out of ignorance.
So what if no one was named as the beneficiary? Does the account just vanish into thin air?
The government takes it. No. No, it goes to their estate. But it's almost as bad as the government taking it because then it goes to court. We have succession. In other states, they refer to that as probate. And then, of course, that makes it subject to court costs and attorney fees. And it can get delayed being tied up in court, which could have repercussions.
So it's really important to keep your beneficiary destinations updated.
Better to have a named beneficiary because that gives you the most flexibility and gives you the longest payout. The estate has to be paid out within 10 years, so it gives you a very short period of time, which could cause the money to be compressed coming out, which could increase your tax bracket.
Can someone leave their IRA to a trust instead of a person?
Yes, they can. Have to be very careful about that because by leaving it to a trust, you can shorten the time for withdrawal if it's not properly done. And in addition, you have to realize trusts start paying the highest taxes very quickly. So generally you don't want a trust to receive taxable income like an IRA distribution. We have a lot of questions where we've done tax planning for people or Medicaid planning for people, and then they go to their other advisor and the other advisor says, well, if you're trying to protect the IRA from the nursing home, they forgot to put the IRA into the trust. We didn't forget. If you take and make the IRA the owner, it's different than making the beneficiary of the IRA, this is making the IRA the owner of the trust, then that's a taxable event. And you can cause all the money in the IRA to be taxable. And we don't do that because we don't want our clients to pay immediate tax on all the money that's in the IRA. The good news is that we do know strategies that if something happens down the road and that client that has a lot of money in the IRA goes into the nursing home, we know how to protect that money from the Medicaid spend down. So as a rule, we generally wait until the client goes into a facility to determine what strategy we're going to use because the strategy varies between if the owner goes into the facility or if the owner's spouse goes into the facility. Two different strategies. So that's why we don't do it. But we get a lot of questions where people have gone to, after we've done the asset protection planning for our clients, and the broker will say, well, they left out this account. We intentionally left it out.
This is a complicated area with big tax consequences, and the rules may vary depending on your relationship to the person who passes away. If you have inherited an IRA or a retirement account or are planning your estate and want to make sure your IRA is handled correctly, please get in touch with LaSavio and Dejan.
We're here to help our clients make informed decisions to protect their assets and reduce their taxes. Please give us a call.